and welcome. This is going to be, I think, the first video that I've started where I actually know what I want to talk about to start with, and we'll just get straight into it, because just looking through the insider buy-in list like I normally do, I came across CROX, which obviously everyone's heard of, the plastic shoes. Just an insider buy-in, two insider buys. There, two insiders purchased it, and they've bought $400,000 worth, which is not an insignificant amount. What I did next, which I don't normally do, is I just immediately went and had a look at the went on Whale Wisdom and had a look at the people that own it, and I noticed straight away this one at the top, Punch Card Management. Now, significant portion of their portfolio, 17%, supposedly only owned recently this year, paid higher price than what it currently is. But for anybody that doesn't know, Punch Card Management is a guy called Norbert, who, if you've watched the Joel Greenblatts investment seminars that are available on YouTube, Norbert is Charlie 479, who he spoke about in the lectures from Value Investors Club, which actually inspired Joel Greenblatt to take a couple of trades, which Norbert wrote about. And I got a funny feeling, I'm not sure if this is true, but I got a funny feeling that he is one of Joel Greenblatt's proteges, where he gave money to start out his own fund, which is what he did with Michael Burry as well. So Norbert, his investment style is very long term, doesn't buy a lot of companies. So when he does buy, it's certainly worth looking into. And as you've seen, he's put a significant portion of his portfolio into CROX. So I've already had a little bit of a look off screen. Already got it in spreadsheet, and read a couple things on Value Investors Club about it. I'm halfway through an article here now. You can sign up to Value Investors Club, anyone can, and like as a free member, and read some of these articles that other people put up anyway. So if you wanted to, then you can sure as hell go and do that. But it's definitely an intriguing investment, especially if someone like Norbert, who very rarely invests in things, is actually interested in this company, and so heavily interested in this company. So immediately that piqued my attention when I noticed it was Punch Card Capital. So like I said, I pulled it up into the main spreadsheet straight away. I didn't do the quick take one, just put it straight into the main spreadsheet. Like I said, it's already quite a bit cheaper than when he purchased it. Revenues have grown a lot since COVID, so that's good. Gross margin has also increased significantly over the years as well, continually getting better. The only thing that has changed is that in recent years, SG&A margin's gone up. Well, in the long term, it's still down. Simple free cash flow margin is very, very good. But one thing that I noticed straight off the bat was that the EBIT share has plummeted, significantly plummeted. And I was like, well, that's a bit strange, because simple free cash flow has not really changed. So I've dragged up the 10Q, and I've noticed that basically they've had a huge asset impairment. Now, according to the Value Investors Club, in 2021, possibly, yes, 2021, they purchased a shoe company called Hey Dude. Now, I've personally never heard of them, but apparently they're up and coming shoe company, and they paid a lot for them for a company that nobody had ever really heard of. Paid 2.5 billion for 500 million in sales. But that sales had grown from 20 million just 4 years prior. So, you know, it was a company that was definitely doing pretty well at the time. Now they've purchased this, and as I've said previously, goodwill's gone on the books, and it tends to be a future write-down. So even big companies like CROX that have got a lot of brand recognition fuck up and make these errors, you know, I guess, in paying too much or something, because on the statement, the asset impairment is for their purchase of Hey Dude. Now it states it here that they've had to impair Hey Dude in notes, goodwill and tangible asset notes. They've had to write down the asset value of around 430 million, and then they've wrote down the goodwill, because the company's not earning anywhere near as what they thought it would do, of a further 307 million. So you've got the huge write down that was stated here. Now obviously an asset impairment, or any impairment, asset impairment, goodwill impairment, that is taken away in the income statement, but actually that's not actually money that's lost this year, because you've paid for that previously. Now GAAP accounting makes you deduct it on from the income statement, but in the cash flow statement, if we go down to the cash flow statement, wherever it is, it gets added straight back in, which is why because it's not a cash loss. For GAAP accounting, it's a cash loss, but it's not an actual cash loss, because this is money you've already paid for in the past. So it's no significance to the current cash flows of the business. So this is why the EBIT's been terribly affected, but the free cash flow, simple free cash flow, has, you know, is reasonably unchanged. Now they have averaged over messed up there. They have averaged over the last 3 years, you know, 750 million in simple free cash flow. So what's that for, you know, two and a bit billion, or you'd purchase half the company for that. Yes, they've got debt, but if you actually look at the total debt as well, because they're earning so much so much free cash flow, the total debt, depending on whether or not these figures are correct, but this is a purchase at the end of 2021, so total debt went through the roof, because I'm guessing they probably financed it with debt, but they're taking huge chunks out of it all the time, and now the total debt's only down to $1 billion. The other thing I noticed that I like is that in the last 6 years, since 2019, they've got rid of 20% of the outstanding shares. So they're earning a lot of money, and they're shareholder friendly. Now I don't know if they've purchased these to retire them. Could be a question we ask ChatGPT, whether or not they can figure that out, find any articles on it. But financially, the company's nowhere near as bad as what it seems, especially off of this one-off impairment, which is not potentially something that's going to go in the future now, go along in the future now. You can see there's been a decline in book value because of it. But because they're paying off the total debt, the tangible book value is also coming up, and it's coming up significantly. When they purchased the business, the tangible book value went from $5 down to -$32, -$33. Now, currently, 4 years later, we're now almost positive again on the tangible book value, because they're earning so much cash, they're able to pay off their debt. So that's pretty good as well. Like I said, simple free cash flow margin, 3-year average, you know, is just under 20%. So this business is, in my opinion, Norbert Lou's opinion, is reasonably good, pretty good business. And all I've done here is I've noticed that a very good investor has purchased this company, and I'm just trying to figure out whether or not I can see similar things. Now, obviously, there's a lot more to it than that. We need to figure out what way the revenue trends are going to go. It seems that CROX have got a significant foothold in China now, and they're very popular in China, so we'll have to look into that and see what that's all about. But for a company that seems to, when you look at the stock price, wrong one, seems to have taken a dive around about earnings. The earnings aren't actually as bad as they seem. Yeah, all right, the guidance for Hey Dude is not good. It seems like they've, in short, made a pretty bad investment there, at least at the moment. But the underlying business is not, it's not decreased 25% in value when the simple free cash flow is, relatively unchanged. Let's just see. CROX have repurchased a lot of outstanding shares in recent years. Have these shares been repurchased and then retired? Are still held as treasury stock. Based on the latest financial data, CROX repurchase shares are still held as treasury stock, not retired. Okay, the consolidated shows a line item under the treasury stock heading indicating shares have been repurchased and held. There's no indication of them being cancelled or retired. So what's that? And stockholders' equity. The sheet is that there. Treasury stock. Right, okay. I mean, I don't really know what happens, so I'm learning in real time here when they purchase them back and don't retire them. As of September 2024, CROX shows approximately $2 billion in treasury stock on its balance sheet and a negative number of shares under repurchases of common stock, indicating the shares are held, not cancelled. So where can we see that? Shows approximately $2 billion in treasury stock on its balance sheet. Yeah, you can see that just here. Treasury stock. And a negative number of shares under repurchase of common stock, indicating the shares are held, not cancelled. Where's that then? Repurchase of common stock. I don't know if I'm looking in the right place here. I have to ask. Historical trend context. Over the years, CROX has consistently expanded its buyback programs from authorization starting at 500 million, now totaling 1.3 billion. That's a lot. Macro trends data shows that CROX treasury stock balance has steadily increased from around 1.7 billion to 2.4 billion and further to 2.5. Buybacks totals. Sorry, just punched the microphone. Buyback totals reported in earnings release match this trend. In 2024 alone, CROX repurchased about 4.3 million shares for around 500 million and continues repurchasing into mid-2025. Let's break down the account. In treasury stock refers to shares that are repurchased but not cancelled. They're recorded as a contract equity account and reduce outstanding shares but remain issued and can be reissued later. Right, okay, I didn't know that. Retired shares, by contrast, permanently cancelled and removed from the issued share account. They no longer exist and cannot be reissued. CROX continued accumulation of treasury stocks. Suggests they haven't chosen to retire the shares. They kept them available for future uses such as employee stock plans or potential reissuance. Okay. Right. Where would you find this bit? Let's see that, because I can't see that. What statement? What financial statement would show you this data? Yeah, but I couldn't see it. Share repurchase, a common stock repurchase, the balance sheet. Oh, consolidated data, stockholders, equity. That's the balance sheet, isn't it? Oh no, hang on, that's the other balance sheet, is it? I don't actually know what this statement is. This is, I've seen it there loads of times, but repurchases of common stock. There we go. Okay. I think I watched a, maybe not, hang on. I was gonna say, I'm pretty sure I watched a Roaring Kitty video once and he referenced this, and this is one that nobody really looks at and nobody knows about, which is something I've just proved, but then not particularly experienced, so. Okay, so basically they've not retired them, which you'd prefer them to have retired them, but at least they are buying them back. So do treasury stock count towards the outstanding share count? This is me not knowing. See, so we were learning in real time. Does not count towards the outstanding share count. Okay. Shares the company's repurchased and hold in its own treasury is still considered issued but not outstanding. Right, okay. Interesting. So back to this. So they've repurchased a significant amount, not retired them. I wonder if ChatGPT knows if they're. Well, they did say, didn't he? He did say that there's been no information on what they would do. They haven't chosen to retire the shares. They've kept them available for future use. Okay. There's no link for that though, see, so that's probably something that ChatGPT has decided. Yeah, suggests. There you go. Yeah, sorry, I wasn't reading it properly. But yeah, this huge drop in earnings hasn't actually happened because it's not real. This loss here of almost $1 billion is not real. So net income would actually be very similar to what it was in 2024. That's even with the Hey Dude portion of their business not doing very well. See what they say about that. Did not mention. Can't be. Oh, sorry, I'm spelling it wrong. Hey Dude, how many times it? Let me know. Mentioned 91 times. Okay, so this is a bit we've already looked at, or I've already pointed out, which is the write down. Yeah, this is just the follow-on of it, isn't it? Yeah. So intangible assets net reported on a consolidated balance sheet consists of the following. Hey Dude trademark. Wow. During the 6 months, we impaired our right of use assets for our former Hey Dude brand warehouse in Las Vegas, Nevada. Okay. Hey Dude trademark and Hey Dude brand reporting unit goodwill. Impairment charge, yeah, okay, we know about that. Know about that. The company entered a credit agreement with Citibank as administrative agent and lender to, among other things, finance a portion of cash consideration for the Hey Dude acquisition. Yeah. So, like I said, the total debt has shrunk significantly. Now, I do want to go back to that, so we'll just do this a minute quickly. Let's just have a look. They've got some operating leases as well. See now, if you were to take subtract them from the expenses, as you know, like Michael Burry and Roaring Kitty believe that you should do, then you probably have a significantly work at that. Yeah, current operating lease liability 82 million, long-term operating, so 400 million you'd lose as well. Long-term borrowings, interesting. So where's this here suggesting that the debt has gone up, which is not what it says on mine. That is interesting. My data from Y Sheets is suggesting that debt is decreasing, whereas this is suggesting it's actually slowly increasing. Total liabilities have just slightly gone up. Okay, that's very interesting. Short-term debt 82.91. What are they using as short-term debt? 8291 there. Operating leases. Okay. Long-term debt 1.6 billion. So why would that be down? By $1 billion on what it was in Q2 last time. 1.7. 1.8. It's down 100 million. There's a bit of a mistake in my spreadsheet here. Because that's suggesting a huge drop. What's going on there? What has happened there? Okay, so scratch what I said before. Total debt has not really shrunk. It still has. It didn't shrink much last year, but it has. They've almost knocked it in half in 4 years since the acquisition, so it's still pretty good. I don't know what happened there though. Seem to have another figure in it then. Anyway. $0.6 billion. What's the SEC thing saying? 1.3 long-term borrowings plus long-term operating lease. I expect that's that. Okay. All right. Well, that's not overly changed in the last 12 months, but it is significantly changed from the point of the acquisition here. That was a mistake on my end for some reason. Not sure why that was in there. So we go back to here. They got a lot of interest coverage there. What's their interest expense? Interest expense for the year, 22 million. And what have I got it on my spreadsheet? 4. Hang on a minute. Interest expense. What's happened there then? Q2, something's not right in the data there. Interesting. Let's see what they say. TTM interest expenses on Yahoo. Got to make sure the financials are correct before we do a lot else. Quarterly TTM, expand all. Interest expense there. 94 million. Okay. Something is not right here. Some 4 million. 72 should be another 20 something, shouldn't it? What's the SEC website got going for it? 22,523. Let's put that in there. Be 94. What was Yahoo Finance saying? 94. There we go. So now we're right. We're in the right ballpark anyway. Still 7 times interest coverage on simple free cash flow. Very good. Historically high returns on capital for both EBIT and simple free cash flow. Obviously, the EBIT is one of the measures on this one which has been significantly affected by the impairment. So if the impairment charge wasn't there, EBIT would be a lot higher. So the return on capital on EBIT would be a lot higher. And as the impairment is historical and doesn't exist in the now, in that it's not money that you've lost this year, you know, return on capital should still be quite high. So all in all, the financial condition of the company looks pretty good. It seems to be dragged down by the impact of their Hey Dude acquisition, which we were reading about here, weren't we? What were we on? 0.16. Let's see if there was revenue breakdowns. We can ask ChatGPT to find that if we need to. So it's talking about the loans for the purchase. So what's this here then? Revenues. Hey Dude, total Hey Dude brand down. Yeah. Down 30 million. I mean, it's not a huge down, is it? Not really. Total CROX brand up year on year, reasonably up as well, 40 million. And what's that? 60 million up on the 6 months, you know. So if we got 60 million up on that and only 8 million down on that, 20 something. So yeah, all right, the Hey Dude brand's not doing very well, but CROX is more than offsetting it. Like, what have we got here then? North America down. Total international sales up significantly, down slightly, 30 million, but up 80 million internationally. So they're losing, you know, a bit in America, mainly from the direct-to-consumer section by the look of it. Yes. But internationally, 40 million up. 60 million up. Okay. Vast majority of Hey Dude brand revenues are derived from North America. Interesting. It appears that a lot of the decline is because of this Hey Dude thing, but the Hey Dude thing doesn't actually seem as bad as what the market is pricing it in to be. What have we got down here? Income taxes. Effective tax rate was, yeah, affected by the impairment of Hey Dude, yeah. Okay. We have two reportable operating segments, CROX brand and Hey Dude brand. Each of the reportable operating segments derives its revenues from the sale of footwear. Yeah. So operating segments. I see they're breaking it down. Interesting, right. What have we got here? CROX, cost of sales increased. SG&A costs increased. And yet they still increased the income from operations slightly. I would imagine they can have some sort of tariff impact, aren't they? This company. So, Hey Dude, 8 million down, saved 6 million in cost of sales. SG&A expenses up 10 million, and they've got a huge asset impairment. It would still be up there, wouldn't it, without that asset impairment? Oops. Yeah, what would it be? 22 million up. That's a significant drop compared to last year, though. It's like 50% drop. Yeah, close to 50% drop there as well. So the Hey Dude brand is struggling. Costs. Okay. It's interesting, though, isn't it? Like, shoes, from what I've seen, are not similar to CROX at all. Certainly not something I would wear. I wouldn't wear CROX either, so. Interesting choice of purchase. I mean, they know more about shoes than I do, but it's like retirement home shoes for me, but there we go. Where are we? Significant accounting policies, all right. Already, we've done all of it. No, all of that. It's just because I've gone off the page, it's lost it. Okay, trends, here we go. Known or anticipated trend. Case. We continue to operate in an environment where consumers are feeling the effects of elevated interest rates, inflation, and future expected price increases, among other things, and as a result, there's more pressure. Also, partners are also acting cautiously, has imposed tariffs on foreign imports from multiple countries, including most relevant to us. Okay, so that's where the SG&A costs would go up, I'd imagine. Let's have a look. Would America's tariffs affect SG and A costs? Spelled tariffs wrong. 2 F's, 1 R. Idiot. Okay. Cost of goods sold, right, okay. It's a dumb question, actually. That makes perfect sense. Has that... I just accidentally changed something. No, I didn't. That's all right. Cost of revenue. It's actually down. Interesting. Sorry, I just had to send a text. Interesting. So the tariffs would impact the cost of goods sold, and yet it looks like their cost of goods sold have gone down. I mean, I guess you could be having not just the Hey Dude stuff, but this could be tariff fallout as well on the price of the business. Complete quantitative assessments, indefinite lived Hey Dude trademark and Hey Dude brand reporting goodwill. Okay, yeah, we know that. Recognize each non-cash impairment. Our liquidity position remains strong with 200 million cash and equivalent, 700 million or 800 million available on borrowing capacity. Total borrowings 1.4 billion. We repurchased 133.2 million of our common stock during the quarter. Interesting, so they're continually doing it. Why wouldn't you when you've got the simple free cash flow that they do? But that's what you want to see in a business, isn't it? Financial and operational highlights. Increase of 3.4%. The increase was due to net effects of higher unit sale volumes in our CROX brands, partially offset by lower unit sale volume Hey Dude, which is obviously what we pointed out. Going through the breakdown of the revenues just now. Brought a net increase, there we go, that's what I said. Lower average selling price of containers, okay. We grew revenues by 5%, 4%. Hey Dude revenues decreased 3.9 to 4.2. I don't know, man. I feel like these sorts of shoes are very faddy. I don't know. I'm literally a jeans and a boots guy. That's it. That's basically all I wear. Jeans and boots. I wouldn't wear these. I can see these though in my very limited shoe experience not being particularly popular all the time. I think there's something that will go in and out. But then Crocs have been like that as well, haven't they? And Crocs have managed to rebuild, so why could they not do that with this? There was a significant period where people were not interested in Crocs, and then post-COVID they've hit it out of the park, haven't they, with the actual Crocs brand. So if they can do it with something like Crocs, why couldn't they do it with these? Right, what have we got here? Asset impairments, talked about that down there. So this at the moment is sort of stuff that we pointed out in the financial statements anyway. Income loss from operations decreased from... Yeah, that's because of the impairment though, isn't it? So that's not a true income loss. Revenues by channel, here we go. Or is this something that we've already really looked at? Yeah. Yeah, there we go. It's just telling us what we've seen a bit further up, just in more in your face. Okay. Interesting. Revenues also increased 6 months, primarily due to higher volume, 3.5% driven by CROX brands, partially offset by lower Hey Dude. Yeah, so we said all this, it just keeps repeating itself. Gross margin increased by 0.3%. Gross margin in 6 months ended, yeah, it's gone up. So if they've got high tariff impact and yet their gross margin's increasing, is that not a sign that management's doing all right? What have we got down here? Asset impairment. Yeah, so we talked about that. Can't imagine there's anything extra significant in there. 430, 307. Asset impairment. No. Reportable operating segments. Following table sets forth information related to our reportable operating segments. Okay. So again, is that just saying the same thing again? CROX revenue increased, which we saw. I've got to be honest, I've never looked through a financial report in this much detail before. There's an awful lot of repeating yourself, or just putting in right in what you can see by just looking at the numbers. Lower volume, higher ASP. What was ASP again? Let's have a look. What is ASP? Average selling price, okay. So where does it say that? Where were we? Okay, yeah. Makes sense. The loss from operations was 705 million, but that was because of the impairment. Decrease of 748 million. SG&A including impairment. So that's why sheets have put it in there as well then in SG&A. Loss from operations today, dude segment was 682 million. All in the impairment, though, this is. Well, it's not, but it's majoritively in the impairment. So what we got here was partially offset by prior year impairments. Hang on. Read the whole thing. I'm trying to skip it. During the 6 months ended compared to the same period in 2024, it's primarily due to the partial impairment indefinitely of the Hey Dude trademark and brand report and unit goodwill, partially offset by prior year impairments costs, the right of use asset for our former Hey Dude brand warehouse that did not recur in the current year. SG&A also increased overall for the Hey Dude brand due to higher costs in the DTC channel, including investment and variable costs. Yeah. Where did we just read that? Sorry. within enterprise corporate increased 3.8 million. 6 month total net cost within enterprise corporate. What does that mean? You chat GPT know. So drag and drop it in. I wasn't obviously reading properly. If figure out that. Talk about a portion of operating expenses aren't tied to a specific brand. Oh, okay, but instead sit in a shared corporate bucket. Interesting. Centralized costs that support the whole company rather than one brand or region. Executive salaries, corporate IC systems, finance and accounting staff, legal aid. I see. This rise could reflect things like higher stock-based compensation, investments in enterprise. What has stock-based compensation done? Not really a fan of it, but the underlying business isn't bad with this, so we could overlook it, I guess. 35 million, blooming hell. So right, store locations, 191. We had 412 company-operated retail locations for the CROX brands, 191 in America, 221 internationally, 63 company-operated retail locations for the Hey Dude brand. What's that in North America? We have 363 company-operated retail locations for the CROX brands, inclusive of 172 in North America, 181. Okay, so that's just what it was last year. So they've almost double the amount of stores. Am I reading that right? 63 company-operated retail locations for Hey Dude brand. As of June 2024, they had 32. Yeah, so they've doubled the amount of stores. Now we're back at that credit facility. We've read that bit. All right. The impairment, that is. We know about that as well. In connection with the acquisition of Hey Dude, we allocate approximately 710 million to goodwill and indefinite. Okay. All right. This is still going on about they're talking about trade protection measures could adversely affect our business. Here we go. Risk factors. Probably read all of this, really, shouldn't we? Interesting to find out what portions of their stuff's made where. I'd imagine very little of it is made in the US. Potential for future price increases in response to tariffs, which could cause the demand for our products to go down and thus have a negative impact on our sales. At this time, it remains unclear what additional effects, if any, will be taken by the US or other governments with respect to international trade agreements. The imposition of additional tariffs on goods imported into the US, tax policy related to international commerce. Yeah. Other effects of these changes include impact on price of raw materials, responsible retaliatory action from other governments, furthermore tariffs or trade. Skipping a bit there. Resultant effect on general economic conditions and on our business as a result of increases in prices for goods we import into our suppliers and vendors purchased depend on various factors such as negotiations between the US and affected countries. All right. Whether or not exemptions or exclusions may be granted. Okay. So basic tariff stuff. Furthermore, tariffs or trade restrictions may lead to continued uncertainty and volatility in the US. We're down here at the moment. Global financial economic conditions and market declining. Such conditions could have a material adverse impact on our business. For instance, is the fair values of goodwill and indefinite lived tangible assets are sensitive to aforementioned potential unfavourable changes. So are they blaming it on that, or In connection with the acquisition of Heydo, we allocated 710 million. Okay, yeah. We evaluated the carrying value of our... Yeah, okay, so they're telling you about an impairment again. Trigger event was down to downward revisions to our forecast. An extended time, we believe it will now take us to stabilise the Heydo brand and return it to growth. This is partly due to current and projected impact of weak US consumer and disproportionate impact of tariffs on Heydo brand products, which became evident in the 3 months ended June 30th, 2025. Our impairment evaluations represent a critical accounting policy as they require significant judgments and assumptions that we believe to be reasonable but are inherently uncertain. Okay. Talking about requiring key assumptions and all that nonsense. We can't be back there, are we? Yeah, we are. So we've read it all with regards to Heydo. So there's no actual... let's have a look here then. Do CROX have detailed revenue breakdowns? Growth in China and other places. They probably do. If you go into transcripts or whatever, they'd probably talk about it. Yeah, so notably driven by China, which became CROC's second largest market. Revenue in China tripled since 2022, reflecting a significant turnaround from previous challenges. We know it's tripled though. Where do we see that from? CROX brand generated 3 billion in 2024. Asia Pacific revenue surged by 46.1%, driven by growth in China, Australia, South Korea, and Southeast Asia. Higher average sale prices continue to contribute to this growth, despite unfavorable currency fluctuations. Revenues grew due to increased volume and higher the information regarding China growth or China and Asia growth from where would I find it? Regional, oh okay, so it was in the 10K. Yeah, it didn't state in the 10Q, we've just been through it. Or are we just looking for the wrong things? Let's have a look. China. Tariffs. Revolving credit facility. Tariffs. So no, it's not in the 10Q. CROX often highlights regional growth in press releases or earnings call transcripts. It needs at China becoming the second largest market revenue. Okay, so we'd have to read the earnings call transcript. Can we find it? On the investor relations page for it. Is it only going to give me the bloody UK website? I hope not. Where are we going to be? Investor relations. There we go. Latest press releases, transcripts, second quarter. Okay. Just flicking through it quickly then. Look at this. To remind everyone, over the last decade, we've deployed 2.4 billion in a buyback, approximately 30% of our total share outstanding. That's good. It's giving you a bigger slice of the pie every time, you know. 38% of CROX brand sales to 52% in the second quarter. Okay, let's see. Growth. All revenue growth rates to be cited on a constant currency basis. I mean, we should be reading this page to page ultimately. I'm just looking at a few buzzwords to see if I can find anything towards the portions I'm looking at, because I think it was in this Value Investors one where they're talking about Chinese growth was huge. It's also actually on here, look. So this is on the latest updates on the TradingView's own page. CROX is thriving in China with a hashtag garnering millions of mentions. Dongmen, what the fuck that means. Showcasing its popularity among young shoppers who enjoy customizing their shoes with Jibbitz charms. So this is, you know, TradingView very, very recently. There you go, there's a Wall Street Journal article there actually. Look how CROX conquered China. I mean, why is the all-time highs up here? They don't pay a dividend though, do they? But they do buy back stock, so 6 of one, half a dozen of the other. I just wish that they'd retire it. We were on this, weren't we? At the end of at an enterprise level, second quarter revenues grew by 1.1 billion. CROX brand revenues up 90%. Hey Dude revenues down 4%. Improvement from the first quarter. Okay, so even though they're down, that's actually an improvement. Enterprise adjusted gross margin is 61.7%, gained 30 basis points. What have I got the gross margin at? 57 TTM. So they're stating that it's better than what my data's saying, so that's something to do, you know, to keep an eye on as well. Okay. Adjusted operating margin approximately 27%. Supported adjusted diluted earnings of $4.23 a share, a gain of 5% to the prior year. They're on about the quarter here, though, aren't they? This would be a quarterly. Yeah, there we go. So where was that? Earnings per share, $4.23. Got to go into the quarterly one for this. Where are we? Are we not? Because I mean, earnings per share is negative there. With the impairment. When was their last? Did TradingView tell you what quarter that was? The earnings? No, it'd be nice if it did actually. Yeah, wouldn't that be nice if it did? What's that date anyway? 7th of August. Period ending June 2025. Well, that's what we're talking about here, isn't it? 7th of August, yeah. We CROX brand, 60% international growth. Very difficult. Like, I'm in two minds about whether or not we should. I know that you should read this page to page to figure out what's going on, but I'm in two minds about whether to do it on the stream because it's not exactly riveting viewing, is it? But then if we're actually trying to learn and learn together, we probably should be doing it. In China, reported another quarter strong revenue growth in excess of 30%. Be interesting, like it'd be nice to know what that entailed though, you know, like figures wise. Just ask this quickly. Do we know what revenue figures are coming out of China. Am I just not looking far enough or not? Are they not given that much detail? Yes, I know it's explained it, but I want to see actual numbers, you know. Let's just have a look here a minute. China. In China, we report another quarter strong rest, bit we just read. China and India led the growth, while Japan and Western Europe also contributed strongly to these results. International revenue is up 16%. Hey brand revenue is down 4%. We know that from reading the other report. Okay. I think you highlighted in prepared remarks, strong growth in China, really successful mid-season festival, strong growth in India, another very large potential market, good performance in Western Europe, and actually returned to growth in Japan. I think our international business remains really important to us. Highlighting Q2 is the majority of our CROX business, right? We passed the 50% mark in terms of the international business being bigger than our domestic business. Okay. That's interesting. The second piece, I'm not 100% sure what you're asking there, what you said. And then on your global CROX direct business is the slowdown that you're embedded in, matching what you're seeing. Okay. Can you elaborate just a little bit on what you're seeing in China? Yes, I think so. So I think what's driving our China business is strong consumer engagement. So the overall China business, you look across many different brands, is not strong from a consumer perspective. Consumer purchasing is certainly not strong in the Chinese market. We are bucking the trend because we're driving, I think, brand heat for the CROX brand in China. The brand heat was driven by a set of social first digital marketing tactics using key Chinese celebrities. Okay. What's mid-season festival in China then? Let it ask. What is mid... Ooh. Still trying to get used to typing with the microphone in front of my face because I can't really see my keyboard. Mid-season festival in China, one of the major e-commerce shopping events, affording the big annual sales like Singles Day. In China, retailers often run promotional campaigns tied to holidays or seasonal events to drive consumer traffic. Okay. Interesting. Mid-season festivals. Alright, just like promotionary stuff then. We also extended significantly our mono-brand stores for our distribution partners in China, significant store openings both last year and this year. Interesting. I think our personalization aspect to our brand, the use of gibbets and the ability to personalize the shoes have also been particularly effective in engaging that consumer, which is what this says. It'll be interesting. I haven't got Wall Street Journal, but oh, this is going to show it. Look at that trading view coming through again. They're interesting. So they're all saying that's the last mention of China then in this. Australia mentioned because that was in the... No. How many times is India mentioned? 6. India saw double-digit revenue growth in the quarter of outsized consumer demand across our classic club and sandal franchises. Brand ambassador garnered 400 million views in its inaugural post. On social media, that is Instagram, yeah. Interesting. China and India led the growth while Japan So they're growing everywhere but China, but at home domestically then. 50% tariff on India that we've incorporated in that number. Okay, so what was the question? Current tariff environment, you mean August 1st, right? Is all that whole litany of new numbers for all different separate countries? Is that kind of new 90 million annual growth unmitigated? And secondarily, the inventory is up 7%. How much of that is now due to the cost of tariffs? That's another thing we need to look at, actually, is the working capital side of it. I've got that here on my spreadsheet. Working capital analysis, day sales payables. Payables has increased, but is it entirely out of line historically? No. What's the average? 57. What are we on? 57. Inventory sales have gone up though, in that it's taken 8 days longer to sell the inventory, but you're still collecting, you know, the money. Day sales outstanding, you're still collecting quite well. So yes, there's an increase in the cash conversion cycle, but it's not significant. And they have the cash flow, you know, to cover the payables. So not in, you know, not so much of a problem. Where else did they mention India? India is meaningful, but not the largest country from which we source exports to the US. Where are the majority? Let's see how much is going to get affected by tariffs. Majority of CROX products manufactured. China and Vietnam. Yeah. So they're definitely going to get hit by the tariffs. I can make a full map. If you make you an image, then it takes away the amount of questions you can ask. So we're going to have to not do that. Historically, the largest production hub for CROX. Not good for tariffs. Vietnam increasingly important in recent years. Used to diversify the supply chain. Got hit with tariffs. Other countries, limited production in countries like Indonesia and Philippines, tariffs. CROX has no major manufacturing in the US. Domestic operations and most distribution and corporate. So basically everywhere that they will manufacture from, tariffs. Interesting. Future. Current environment, we see the US consumer behaving cautiously around discretionary spending. They're faced with current and implied future price increases. Acting more carefully in reducing their open-to-buy dollars. We strongly believe this is time to make bold decisions for the future to sustain and advance our durable cash flow model. Interesting, isn't it? Because there's potential for huge future growth. It's doing very well in China, and obviously internationally is now overtaken domestically. And potentially, that little snippet back there, domestically is impacted because people are just unsure on what's coming in the future. Is that a permanent thing? Is it long term? In June, we launched our latest campaign. Hey Dude Countries campaign is rooted in the authenticity and plays into several of our brand affinities, including music, pre-post and post-sport travel. Okay. This is on the old people's home shoes. The cumulative impact of our marketing efforts over this period has resulted in an increase in aided awareness to 35% in the north. Okay. So they're trying to bring more eyes onto the Hey Dude brand. Lastly, we launched Paul Pro, an elevated iteration of our best-selling Paul silhouette at an $80 price point. Is this Hey Dude? Never heard of these shoes they're talking about. Hey, dude. Oh, could be, look. Yeah, there we go. Paul Pro. I mean, they don't look so bad. Still not my boots, but they're more wearable than them. Not that I'm giving fashion advice because I haven't got a fucking clue. Okay, where are we? Stabilise the North American market while laying the groundwork for future international growth. We are pleased by continued growth of our direct-to-consumer channel, up 7% in the quarter. This is supported by our new store openings and strong performance on TikTok. In closing, we believe the Hey Dude brand potential and its community are much greater than the size of the business today. I'm confident the critical steps we're taking will fuel the potential in the future. Okay. While we can't predict future tariff changes, we are planning our business at the current rates. The impact from these incremental rates increases creates approximately 40 million in the second half of 2025 and 90 million on an annual basis. So what's this? The cost that it's gonna cost them. Okay, so it's a very meaningful change in terms of dollars that we are foregoing in North America for future health of the brand. I haven't quantified in dollars the amount of pullback relative to the reduction in discounts. Just follow up on the pullback and promotional activity in CROX in North America. Okay. What I could say is if you look at Q2, which is down essentially almost 6% for North America for CROX, if we had, I think, not made a decision, it would have been down slightly. So it's pretty meaningful impact. And yes, I think to your question, we will still run, I would say, competitive discounts and promotional events around key events. Absolutely, we will. But we're being careful about the depth and breadth of those events and also making sure that we are not running significant events between those time periods. So it's a very meaningful change in terms of dollars that we are foregoing in North America for future health of the brand. Why do you think your losses are accelerating now, Seg? Well, I'm not sure I agree. Right, in terms of the athletic trend, I think there are some high-end athletic brands that have been performing very strongly in North America for some time, but are selling at high prices and principally selling at an elevated level to consumer in the broader athletic trend that hits a broad consumer base. Okay. He didn't really answer that question though, did he? No, he didn't answer it. Okay, so talking again about how they've so-called increased brand awareness by 35% for Hey Dude. Okay. All right. This is interesting, isn't it? This is interesting, considering how cautious Norbert Lou is. The price that he's purchased at compared to now. Let's read this Wall Street Journal article. For the better part of a decade, CROX stumbled in China. Its stores stocked shoes Chinese people didn't want, such as loafers, and its celebrity endorsers for the likes of reality show contestants and mid-tier actresses. Shanghai subway cars are packed with fashionable croc wearers, often young women in platform clogs studded with charms known as gibbets. So many fans of the whole field shoes make posts with the hashtag Dongmen, Chinese slang for croc fans. Okay. I mean, that would mean something completely different in the UK. And that the company has announced on earnings calls the number of Dongmen mentions, which today tally in hundreds of millions. Very immature. Once a tiny fraction of Croc sales, China has grown into the brand's second largest market after the US. This month, the company said revenue in the most recent quarter fell 6.4%, but was up 30% in China. CROX, which is based in Broomfield, Colorado, has become a rarity. An American company that's rapidly growing in China. Nike and Starbucks have struggled against fast-moving local competitors with lower prices. They both say they are turning a corner. This is a thing, right? What's to stop Chinese companies stealing and making their own? I suppose you wouldn't have the brand name. CROX is a brand name. Whether people think their shoes look stupid or whether or not they think they look great, people know CROX. China's slowing growth has caused many budget-conscious consumers to turn away from premium American products. Retail experts say that CROX offers lessons for Western brands. Biggest is to focus on unique preferences for Chinese consumer. CROX marketing campaigns such as an ad featuring pop star Tan Jianxi and pink platform CROX riding the pink whale through the sky are dreamed up in Shanghai, not Colorado. Okay, so they're using the locals to make sense. Company recruits the glitziest names in Chinese culture as brand ambassadors. It tweaks its global slogan, "Come as you are," to a Chinese language version, "Born to be free," appealing to many young Chinese who yearn for more relaxed and less competitive life. Taking creative risks. Chinese-born designer. Knee-length biker-style CROX. Bloody hell. That, yeah. KFC collaboration CROX. CROX has run a playbook that most global organizations know that they should run. They've just done it well. While some US brands are tarnished by their association with Chinese main geopolitical competitor, CROX has another advantage. Few Chinese know American. Okay, that's interesting. Even as CROX revenues began to flag in North America, it has more than tripled since 2022 in China, with certain sought after CROX can go for $250 or more a pair. Reinvest much of that margin it earns on its shoes into marketing. Brand president visited Shanghai in 2020 and hardly saw any CROX on the street. She came back in 2023. She remembers stepping off the plane and immediately seeing a fashionable man. Okay, I was like, okay, this is real. Company groups its buyers into two buckets. Okay. CROC wearers are mainly feel good. In China and other Asian countries, explorers are better represented. Okay. So it's the in thing in China at the moment. Then, that's what they're saying. Yeah. Choose Ranieri Jr.'s CROX first distributor in China came to Shanghai in 2006 with a duffel bag full of CROX. He clumped on around the streets of Shanghai wearing brand gradually gained traction, but after a few years it began to struggle. Quickly realised that China is both an opportunity and a problem. It was a long reset because we needed to actually change the entire perception of the brand. The company announced its first A-list Chinese celebrity ambassador, actress Yang Mi. Okay. Pulling back as other big brands did, instead CROX doubled down, funding Chinese advertising with money from the sales in the US. Interesting. Where the pandemic era work from home set drove a boom. That was a big turning point. Stranger on the street in 2021, pairing platform CROX with light coloured socks. It was ugly at first, but the more I wore them, the more I liked it. She eventually got 4 more pairs. Wow. Gibbets. It played well on the platform based around user-generated content and self-expression. Okay. Today, as a roster of celebrity endorsers and collaborations, CROX is working hard with the hottest Chinese retail brand, Pop Mart. Interesting. Interesting. Not interesting. Right. A few more questions to ask on this, really, isn't there? Probably not going to do it now, but we've made a good start. Right, okay. Let's put some future figures in, shall we? What are we going to say? Growing everywhere, declining in America. Let's be conservative. You say 3.8 billion. What is it selling at multiple wise historically? Simple free cash flow. Oh, that's difficult. That is difficult. Because compared to this, it's just got cheaper and cheaper. Considering revenues have gone up. That's an interesting thing to note, isn't it? Look how much revenues have gone up. And look how much the simple free cash flow multiple's gone down. Where is... I got EBIT. I've got EBIT here. Look how much EBIT's gone up. EBIT multiple gone down. Other than this year, impairment. So what would it be? Company that's growing. Should it be going for 10 times? Why shouldn't it be going for 10 times, you know? When historically it was ridiculous. What have I got in there at the moment? 4. Let's just put 8 in, be conservative. I know that's less than what it's going for now, but 6 times compared to, 13 times. Revenue is more than doubled. Share count gone down. Gross margin gone up. Average simple free cash flow margin gone up. Slightly undervalued on the Pry one. Overvalued on the Greenblatt one. Is it? I don't know. What have we got in here actually? I haven't used this for a little while, so I just need to figure out where these figures come from a minute. Let's just change that a minute. What am I looking for? That one, I think. Earnings 7. So it's only trading at a potential simple free cash flow multiple of 1.4 on future earnings. If future earnings over the next 5 years were 3 billion, 2 billion. Where's that come from? I'm sorry, I'm just trying to work my own bloody spreadsheet out now. C6 divided by F36, or times F36 with C6. 3.8. F36. Where's that? That. I don't know, I'm going to have to figure out what I've done there. But over the next 5 years, discounted to the future. Even if that's, you know, look what simple free cash flow is now, 700 million. So you're looking at like a 200 million drop, knowing that China and Asia is growing, India is growing, America's dropping slightly. You know, present value, 2.4 billion. What's it trading at currently? 4.7. So that's 2 times earnings. Where's that 58.96 come from? Future simple free cash flow share. Oh. This came from Joel Greenblatt's class notes, and they don't appear to discount it back to the future. I'll find it another time. I've highlighted it in the class notes. You can get the transcripts of all of Joel Greenblatt's Columbia lectures where Richard Bazina went in and they were talking about Lear Corp, and they weren't discounting the future cash flows back for their multiple-based analysis. So that's where that's come from. So, graphic calculator, 50, say $56, say times it by 6. Oof. Okay. And they could continue buying back stock. Interesting. Right. I'm going to look a bit more into this. I might put some comparison analysis into it. Maybe next time. Maybe we'll do that in the next video. But for now, I'm going to leave this here. Leave the question open. It's definitely an interesting company though, isn't it? We can say that much. All right. I hope you learned something today. I certainly did. If you've watched this far, thank you very much. Please like and subscribe. And I will see you next time. Thank you.